Welcome to Wealth Pathway. If you are watching this video, then congratulations, you are among the very few people in this world willing to look through the noise to find the signal. That number flickering on the screen isn't just a price, it is a thermometer measuring the high fever of a dying financial system. The underlying logic of global financial markets has experienced an irreversible fracture. London spot silver has broken through $94. And gold is knocking on the door of $4,700. For the past 40 years, textbooks told us silver is poor man's gold, an industrial metal subservient to manufacturing cycles. They told you, if factories shut down, if the economy slows, silver will crash. But take a look at the data. Within 50 days, the price doubled. This isn't called a bubble. A bubble means there is air inside, poke it and it bursts. What we're seeing now is a vacuum, a massive vacuum formed after physical assets were completely drained dry in a world flooded with paper money. Today, we will dissect why all the iron laws of investing from the past 40 years have completely failed at this very moment. We will review how the tariff war between the US and Europe, AI's greedy appetite, and the quiet emptying of London vaults have together brewed this perfect storm. This is not investment advice. This is an autopsy of the old world order. Let's set foot on this wealth pathway. Let's start by breaking a myth that has misled investors for half a century. Pick up any macroeconomics textbook from before 2020, and it will tell you this formula. Silver is an industrial metal. Watch the PMI closely. If PMI falls below 50, it means manufacturing is contracting, demand is declining, silver is bound to fall. This rule used to work well until it completely failed. Look at the December 2025 ISM data. US manufacturing PMI is only 47.9%. What does that mean? We've been below the expansion-contraction line for 10 consecutive months. Factories are slowing down. Container throughput is declining. Global traditional trade is shrinking. According to the old logic, silver should now be struggling around $25 or even lower. But the reality is, we're standing at a high of $94. Why? Because we've entered the Great Divergence era. The global economy has split into two completely different stratospheres. The old economy, those industries producing plastic toys, disposable consumer goods, traditional building materials, is indeed in decline. This is the signal PMI captured. It is the death rattle of the old world. But the new economy, the future infrastructure tied to national strategic security, is overheating, frantically scrambling for raw materials. Solar panels, AI computing centers, aerospace and defense, edge computing terminals. These aren't optional consumer choices, but rigid imperatives for national survival. This brings us to a critically important concept: demand inelasticity. Whether the economy grows or contracts, governments must build solar power plants to ensure energy independence. Tech giants must build data centers to win the computing power arms race. For these industries, silver isn't a choice, it is a must. Even if silver prices rise to $100, they have to buy, because without silver, there is no conductivity, there is no future. So look at this data. The gold-silver ratio has collapsed to 49.9. This is a 14-year low. The last time we saw this number was at the peak of the 2011 silver bull market. But unlike 2011, that time it was retail investors frantically speculating on silver coins. While this time, it is industrial supply chains panic hoarding. The market has finally realized one thing: the Federal Reserve can print trillions of dollars, but it can't print a single ounce of silver. Now, let's overlay the geopolitical layer onto the economic charts. The backdrop is January 2026, a year since Trump returned to the White House, and the creed of America First has evolved into America Isolated. On the 17th of January, the announcement that changed everything was released: a 10% tariff on goods exported to the US from 8 European countries, including Denmark, Norway, and Sweden. Effective the 1st of February, by June, this figure would skyrocket to 25%. The media downplayed it as a trade dispute. But in my view, this is the fragmentation of the transatlantic alliance system. What does this have to do with metals? Everything in the era of free trade. Metals circulated globally. Silver in London was no different from silver in New York. But in a world with towering tariff barriers and frequent trade wars, the efficiency logic of just-in-time delivery has transformed into the security logic of just in case. When supply chains break, trust evaporates. European manufacturers began to panic. What if I get sanctioned too? What if I can't buy delivery receipts from New York's COMEX? So they started front-running. They no longer trust paper contracts, but instead demand that physical silver be shipped back to European soil, stored within their own line of sight. This is a massive risk-aversion exodus. But unlike previous crises, where capital fled to U.S. Treasury bonds, this time capital is fleeing from sovereign debt towards sovereign assets. Gold and silver are the only assets in this world that are not anyone's liabilities. The tariff war is essentially a demonetization of trust between allies. When you impose tariffs on allies, you are forcing them to seek independence. And independence requires hard assets as backing. The $94 silver price is not just a reflection of inflation, but a premium for global geopolitical risk. Let's dive into the market's plumbing system. If you like tracking physical money flows, this is where the story gets most exciting and most terrifying. For years, the London Bullion Market Association and COMEX formed a relatively balanced ecosystem, with metals flowing across both sides of the Atlantic, smoothing out price spreads. Now, this mechanism is broken. Throughout 2025, we've witnessed a bizarre phenomenon, the Great Silver Migration. Initially, due to concerns about U.S. tariffs and dollar weaponization, global capital tried to flood silver into the U.S. seeking so-called dollar zone safety, which led to a sharp decline in London vault inventories. But then, the plot twisted. As London vaults bottomed out, local silver lease rates in London began to skyrocket. Let me explain for those unfamiliar with this term. Lease rates are the cost of borrowing physical metal. When lease rates skyrocket, the market is screaming one thing: spot shortage. This triggered violent arbitrage trading. Traders realized that holding paper gold and paper silver contracts in New York was useless because industrial delivery requires physical metal in London. So, we witnessed the great reflow. Look at this set of data ignored by the market in October 2025. In just 1 month, London vaults recorded an inflow of nearly 1,700 tons. Where did all this silver come from? It was squeezed out from the rest of the world like toothpaste. Look at the UK's trade data again. This is a textbook level reversal. In January 2025, the UK was still a net exporter of silver, with a net outflow of 2,000 tons. By November, the UK had become a net importer with net purchases of 1,650 tons. This is a 180-degree turnaround. The UK, the heart of global precious metals trading, has transformed from a blood vessel into a black hole. It no longer pumps blood outward, but is desperately sucking it in. The latest data as of the 13th of January 2026, COMEX registered inventory has dropped to 435 million ounces. Sounds like a lot. Don't be fooled. The vast majority of this is locked up by large ETFs considered dead chips and won't circulate in the market at all. The real floating chips, the physical inventory available for delivery and industrial use, have become as thin as cicada wings. We are witnessing a global game of musical chairs. And now, the music has stopped. Now, let's talk about the fundamental driving force behind this bull market. This isn't just about money. It is about physics in the past. But today, silver is the neural conductor of the digital age. The macro narrative of 2025 and 2026 is dominated by one technology, artificial intelligence. But people often overlook AI's physical nature. AI isn't just code in the cloud. AI is physical. AI requires massive data centers, and data centers need to devour astronomical amounts of electricity. And in this age of carbon neutrality, the only way to provide this kind of electricity at scale without being strangled by environmental regulations is renewable energy, specifically photovoltaics. Silver is the most electrically conductive metal on the periodic table, bar none. It is the non-negotiable core material for high-efficiency photovoltaic cells. The Oxford Institute's report puts it very precisely: silver is the next-generation core metal for the green transition and digital transformation. Imagine this scale. In 2024, the global photovoltaic industry consumed over 6,100 tons of silver, a 67% increase from 2 years ago. And by 2026, with technological iterations, the latest N-type cells, in pursuit of higher conversion efficiency, saw silver consumption per unit area not decrease, but actually increase. Moreover, AI hardware generates enormous heat. Heat dissipation is the bottleneck limiting AI computing power. Silver's excellent thermal conductivity makes it a key material for cooling systems and connectors in high-performance computing components. From edge computing chips in your self-driving car to the super servers training the next GPT model, silver is everywhere. China, as the most strategically minded player globally, was the first to realize this. In October 2025, a document released by China's Ministry of Commerce classified silver alongside tungsten and antimony as rare strategic metals. At the time, Western analysts scoffed, saying, "China is a silver importer. How could they control the market?" These analysts were dead wrong. They didn't understand supply chains. Although China doesn't own the most silver mines globally, China dominates global smelting and advanced processing capacity. By tightening exports of processed products like high-purity silver powder and silver paste, China is effectively strangling the downstream industrial chain by the throat. This isn't a war about ore. This is a war about chip-grade materials. We are falling from a world of free trade into a world of resource nationalism. Mark Twain said, "History doesn't repeat itself, but it rhymes." Right now, the rhyme we're hearing sounds a lot like 1978. Back then, we faced the three horsemen of the apocalypse: economic stagnation, inflation, and a crisis of confidence in the dollar. Looking back at the Super Bowl market from 1970 to 1980, the gold-silver ratio started at 19, expanded to 47 at one point, and finally crashed to 14 when silver prices went parabolic. Why did silver outperform gold during years of runaway inflation? This is a matter of crowd psychology. When inflation becomes deeply entrenched, public psychology undergoes a qualitative shift. People stop looking for yields and start looking for stuff. People panic, buy physical assets. Gold is too expensive, that is a game for central banks. But silver, with its low unit price and high volatility, carries the speculative frenzy of the masses. Today, what we're facing is stagflation 2.0. Stagnation. The real economy is slowing down. Just look at those dismal PMI numbers. Inflation, due to deglobalization, supply chain disruptions, and war risks. Prices are extremely sticky. Crisis of confidence. The US debt spiral is out of control. The dollar has been weaponized, leading to the global South's departure from the dollar system. But there is a key distinction here that makes today's market fiercer than 1980. The silver buying in 1980 was mainly driven by the Hunt brothers' manipulation and retail speculation. Today, the buying is institutional and sovereign. Central banks in emerging markets around the world are buying gold, regardless of cost. When gold prices approach the $5,000 mark and become too expensive, the spillover capital starts flooding into silver. Silver's elasticity is astonishing. In the 1970s bull market, silver rose 1,500%. In the 2020-11 bull market, silver once again outperformed gold. Since 2019, silver's gains relative to gold have approached 2 times currently. We're in the $80 to $100 range. This is the most dangerous zone and also the zone with the strongest wealth creation effect. This is the moment when volatility will destroy leveraged traders, yet reward spot holders. So where are we headed? Dutch veteran investment expert Karel Merks once issued a warning. If silver prices continue to stay above $100, we will see demand destruction. PV manufacturers might stockpile a year's worth of inventory and then halt production to wait and see, or spare no expense in developing copper substitution technology. This would create a supply cliff. If prices rise too fast, too high, industrial users might number, causing a vacuum-like price pullback. However, the floor price has been permanently raised. We can never go back to the $20 silver era. The structural deficit is too deep. In 2022, the global supply gap was massive. In 2025, the gap has widened further. Currently, the globally identifiable above-ground inventory has fallen below 40,000 tons. If you subtract the inventory sitting dead still in ETFs, the free float is nearly zero. We are facing a convergence of 3 threats. First, the Fed's policy uncertainty. Powell is mired in deep trouble, and the next Fed chair candidate, Kevin Warsh, has unclear policy leanings. The divisions within the Fed have become public, and this policy wavering is the best fuel for precious metals. Second, the spiraling escalation of the Middle East situation. The US-Iran standoff isn't just about oil. It is more about the security of global logistics channels. Any surge in energy costs will directly drive up mining costs, thereby raising the floor for metal prices. Third, substitution failure. The industrial sector wants to replace silver with base metals, but under the hard constraints of 2026 climate targets, they're running out of time. They're forced to pay high prices. Finally, let's zoom out. What we're seeing at $94 is not just a surge in commodities. This is a repricing of reality. For the past 40 years, the Western world has enjoyed the great moderation, cheap goods, cheap energy, cheap money. That era was built on efficient global supply chains and stable dollar credibility. Now, both of those foundations have collapsed. We are entering an era of friction. Friction means cost. Friction means you need to own physical assets, not paper contracts. Friction means whoever controls resources controls the narrative. The volatility ahead will be stomach-churning. We might see prices pull back to $80 next week, or shoot straight up to $120. But that is just noise. The trend is crystal clear. Wealth is transferring from those who hold currency to those who hold resources. The window to exchange paper money for metals is closing, not because prices are too high, but because you might not be able to buy any at all. In moments like this, stay rational, stay liquid, and most importantly, don't stray from this path. Thanks for watching Wealth Pathway. See you next time.